The 90s. I want to go back to the 70s when Mohammed was a student. Mohammed, the word of the moment coming out of the 70s, for that period, stagflation. That word is getting thrown around a tremendous amount on Wall Street and beyond at the moment. How useful is that word? Or rather, how useful is it not, Mohammed, at the moment?
It is useful as a significant risk. I call it stagflationary winds. Growth is declining. We saw the China numbers yesterday. Inflation is going up. Mike just shared with you Europe and the US. Let's not forget Germany at 4.1%, the highest inflation rate in 30 years there. Inflation is a global issue, but I call them stagflationary winds because they need not result in a stagflationary trap if you get the policy adjustment. And the policy adjustment has to be both on the stag side and the deflationary side. Stag about increasing productivity, growth. Think of infrastructure, think of other measures to promote productivity and growth. And the inflation side we talked about. So it is there, it is a risk. But again, there's nothing inevitable about it. Now, if it becomes not just part of the journey, but the destination, that is really bad news because it will paralyze policymakers. They won't know which way to look.
Well, let's talk about the policymakers, Mohammed. I want to go there. This is an EM dilemma that you know very well, better than most. It's upside risk to inflation, downside risk to growth. We could have real GDP growth in America next year of 4%. I don't like the stag part of stagflation if we get that. But can you explain to me what that EM dilemma looks like in developed markets? You touched on this earlier, a central bank that could be overwhelmed by the inflation side before they reach their employment goals. What does that look like?
So for central banks, I think it's clear what will happen if we continue with these high inflation prints. And I want to stress today's PCE is going to be ringing alarm bells at the Fed. Inflation isn't going down. Month on month, as Mike said, is 0.4 for headline, 0.3 for core. Inflation is hot at the core level. And you know what? If you do the pure statistical calculation, it's very unlikely they can get to that target. So they're going to be revising their end-year target up yet again, and they're going to be signaling to the market yet again that they don't understand the inflation dynamics. So this is consequential. And the risk is, John, that at some point, the market challenges them. The market will not challenge them with purchases of 120 billion.
Yeah.
But the minute those are lower, people will have the courage again to short the bond market, and you risk a disorderly adjustment in the bond market. And that's what we've got to avoid at all costs.
You said at some point, let's explore the at some point just a little bit more. There was an interview that we had earlier this year with Vice Chair Richard Clarida. Tom and I conducted it. I remember at the time, Mohammed, you joined us shortly thereafter. He said, when I asked, how will you know if you're wrong? When will you know if you're wrong? He said the turn of the year. Why is the turn of the year so important, Mohammed?
Because Rich Clarida put it out there. So it's the only thing we have in terms of how they judge transitory. Most behavioral economists will tell you that's way too long. The whole notion of a transitory development is it doesn't change behavior. It doesn't change wage setting behavior. It doesn't change price setting behavior. Like you, I talk to lots of people on the ground, and these behaviors are evolving. They are changing. Companies feel more confident to increase prices because prices are going up everywhere. So the end year was really something that Rich put out there. But the real test, John, is do we see inflationary expectation, price setting behavior, and wage setting behavior changing?
Mohammed, I know you have somewhere else to be. You've got a meeting, and you were kind enough to give us some of your time this morning. So just a final question before you run, if I may. You know how these companies work. You're on the board of several of them. I don't want to talk specifically about them. I know you can't do that today. But what we have seen is issues with supply meeting really robust demand. As you look out to next year and you think about corporate profits in America, are we thinking increasingly about a dynamic of profits deferred or profits lost? The reason I asked that, I saw the earnings from Nike a couple of weeks ago, the last week, see it from Bed Bath & Beyond yesterday. Those difficulties are weighing on profits. Are those profits that are lost or deferred into next year because of this supply side problem?
Most of them are revenues lost, and they will not be regained quickly. I honestly do not know of a single CEO that I talked to, and I talked to quite a few, John, who does not believe, she or he, that supply disruptions will continue into next year. They are planning for supply disruptions. And that means that they are starting to worry about maintaining output levels, even though demand is there. So these things will persist. There's no quick catch-up in terms of revenue. This is foregone profit, foregone revenues, unfortunately.